Another issue that requires address is the determination of the transaction price, which basically determines the amount of revenue that can be recognised. Now, this might not seem an issue where you have immediate payment of a fixed amount. However, that's not always going to be the case. For example, there may be deferred payment, and this is referred to as there being a significant financing component to the sales transaction. In this circumstance, the determination of revenues is more complex, and essentially it adopts a present value approach to the determination of the fair value of the revenues to be recognised. So let's think about what this means with a simple example. We have a firm which sells a machine making propeller drones. It sells the machine for $100,000, and there are 60 monthly installments of $1,887.12 payable. The implicit interest rate in this payment structure is 5% and paid monthly, and this is the same as the borrowing rate for the purchaser. Now, that dictates that the appropriate discount rate for the cash flows is 5%. Now, just so you can see where all the numbers come from, I've used Excel here, and I've put in the present value, $100,000, the per annum interest rate, 5%, the per monthly interest rate is 0.417%, and there are 60 monthly payments. If you use the payment function in Excel, you can see that this tells you that there are 60 monthly payments of $1,887.12 required. And if you multiply that by 60, you can see it gives rise to total payments of $113,227. Now, quite obviously, we don't recognise the total value of the payments. We can only recognise the net present value of those payments. So what I've done next is I've calculated the net present value of the payments. It's a little bit circular, but just so you can see the process, that's all. And what you can see here is that the net present value of those cash flows is $100,000. And so when it comes to recognising the revenue, what we'd recognise on the date in which we sell the machine would be revenue of $100,000. So on the 1st of July, when we sell the machine, we'd recognise revenue of $100,000 and an account receivable of $100,000. For the next 60 months, we'd then recognise the receipt of the monthly payments of $1,887.12, and of that payment, $416.66 will be allocated to interest revenue, and this is in the first month, $100,000 times the 0.417 interest rate, and the remainder is allocated to the receivable. You could do that for the life of the payment structure, and you'd find that after the end of 60 months we came down to an account receivable of 0. Now, just to appreciate how things change if you have a different interest rate, a firm sells a machine for making drone propellers again, same payment structure, but now the borrowing rate for the purchaser is 10%. The borrower is more risky, and that would dictate that the present value of the cash flows that we're going to receive has declined. So it starts off the same, but what you can see now at the bottom of the slide is that when we discount those cash flows at a 10% interest rate per annum, 0.833% per month, this tells us that the net present value of the cash flows is only $88,818 now. So what that tells us is that when it comes to recognising revenues, on the 1st of July, we'd recognise $88,818.16 when we sell the machine, and a receivable for the same amount. And when we receive our first monthly payment, we'd still recognise the receipt of the monthly payment, $1,887.12, and we'd recognise a higher interest amount now. Why? Because there's now a greater risk, and so there's a higher interest rate being applied to the receivable. So it's going to be $88,818 times the higher interest rate, which gives us $740.15, with the remainder allocated to the account receivable.